There are only 5 main games traders choose to play, and every game has its own rules, which means that if you don't respect the rules, you will get wiped out. But that also means that if you do respect the rules, you can actually master the game and make a stupid amount of money doing so. My name is Brad Goh. I've been trading for 7 years, and in 2025, last year alone, I made over $2.2 million in profits, with every single trade documented live on my second channel, Brad Trades. Right now, I'm building an 8-figure investment portfolio before the age of 25. So if you want to follow the journey, hit the subscribe button. I've also helped hundreds of students become 6-figure funded traders, and I'm the founder of EdgeFlow, the trading super app built for discipline and consistency. So quite simply put, I don't want your money. I just want you to become a better trader. Now, quick clarification before the comments start getting annoying and say, "Oh Brad, you forgot about the other asset classes like bonds, REITs, indices, and commodities." Well, first of all, indices and commodities aren't separate games. They are just things that you trade. They are part of a certain asset class, which I'm going to cover later. The real game is the instrument that you use, like stocks, futures, options, Forex, so on and so forth, because that decides everything that matters. Leverage, cost, speed, and complexity. And then there's bonds and REITs, which is real estate investment trusts. But let's be honest, 99% of you aren't trading those. So I'm not going to be covering them today. Now, before we start, I want you to understand this core concept. You cannot hit mastery if you keep switching to a different game. You can't build deep pattern recognition if you are trading a different asset every single day. You can't build intuition if you are changing strategies every week. Mastery involves depth, not breadth. It's going 1 inch wide and a mile deep until you know your market so well that you can trade it half asleep. Also, I'm not going to be teaching you the basics of what each market is in this video. You should already know that by now, but if you don't, I've got a full free playlist linked below teaching you how to trade each of this market. So you might want to go and watch that first and then come back to this video. Anyways, in this video, for each game, each asset class, each market, I'm going to break down what it is, who is it for, the pros, what is good about it, the cons, what is bad about it, and the one constraint that wipes most people out, like the one biggest bottleneck about it. And last but not least, how to win in that arena if you choose to participate in it. So the first asset class is stocks. When you are trading stocks, what you're essentially doing is that you are buying or selling shares of a company or a basket of companies. All right, so it's not just, you're betting for price to go up or down. No, you are literally buying shares of a company. So if you believe that a business will grow, what you do is that you enter for a buy. If you believe that the short-term or long-term value of a company will decrease, will drop, then you actually enter for a sell. Right, and who is it for? It's for traders who want the highest chance of making money long-term and don't need action every day. Right, so to me, I really believe that stocks is the best asset class if you prefer a much more longer time horizon and you are a long-term investor, right? Which means you plan to enter and you don't plan to exit for a few weeks, a few months, or even a few years. If that's you, stocks is the right asset class for you. Now, pros, which is what's good about stocks. Well, it's incredibly great for long-term compounding, right? Because as you know, the 8th wonder of the world is compounding. Time is the multiplier, and the market tends to reward people who can hold through the noise, right? The longer the runway, the higher the returns you can potentially get when you eventually do sell the stock. You also have the ability to diversify, which means that you can spread risk across different sectors, different countries, and even just buy the whole market via ETF, right? Which is, once again, like I said, a basket of the best companies in their particular industry, in their particular sector, or could be like S&P 500, which is like literally the biggest 500 companies in the United States. And it's also simple to execute at scale, which means that there is low complexity. This means that it's very easy to understand, which also means that there's going to be a low barrier to entry, which means that anybody, any Tom, Dick, and Harry, any 10-year-old can probably understand how to buy and sell stocks. Since there's low barriers of entry, what this means is that there's lots of liquidity, which means a lot of people are actually trading, stocks, right? And this is why the app Robinhood has been doing extremely well recently. It's because nowadays the millennials, the Gen Z, they are all trading or investing or having some form of skin in the game in stocks because it's so easy to actually get into it. It's so easy to enter or exit positions without needing fancy products, 5 different monitors, or even leverage. Now, the downside, which is what's not so good about stocks, right? The cons, once again, cons are subjective. Some of this might actually be pros if you look at it from a different lens, right? But just from an objective standpoint, the downsides is that it has a slow feedback loop, right? Which means that you can't expect to like make money in seconds or make money in minutes unless you're trading a very large volume. Which means that it's going to be very difficult for impatient people, right? People who want things fast, who want the instant gratification. And this also means that you can be technically right about a trade ideal, but then if you're wrong about the timing, you can potentially be wrong for weeks, months, or even years before the move plays out. And if you look at the example, look at Michael Burry, the 2008 financial crisis. If you guys have watched The Big Short, you will know that he pretty much betted that the entire market is going to crash, but he betted it way too early, right? So it took months for the trade to actually play out properly, right? So he was in a lot of drawdown before he actually started making money. It's the same thing right here. There's this adage on Wall Street which says that being too early is just as bad as being wrong, right? So it's like you can be right about the trade ideal, but if you're wrong about the timing, guess what? You're probably not going to make as much money as you want, or you're going to have to wait a very long time until you actually get the returns that you actually desire. And the thing about stocks is that it needs more capital than the other asset classes to start, since there is like not much leverage involved in stocks, right? Which means that what you see is what you get. What you pay is what you get. This also means that every position size matters. And if you're trading on the tiny accounts like $100 accounts, you realize that it's going to take a longest time for you to grow that $100 account into like, let's say $50,000, if that's even possible. Maybe that's possible. And stocks can underperform for an extended period of time when the market is in a downturn. If you look at the tech stocks, the AI stocks, they're all correlated with the entire stock market as a whole. So if the entire stock market starts crashing, you notice the AI stocks, the tech stocks, whatever, they start crashing as well, right? So this means that once again, you could be right about the trade ideal. But if the entire market, the entire fundamentals that is driving the market is causing the market to move in the opposite direction, guess what? You're going to be in drawdown. You're going to be stuck in this consolidation, sideways market for a long ass time. Now, here's the big hairy problem, or rather like the biggest constraint about trading stocks. I feel like out of all the asset class, which I'm going to share with you later, stocks is probably one of the one that is like more predictable, right? Which means that it's a little bit more easier for you to trade stocks since there is lesser variables inside the market. And also since there's a lot of information, right? So to me, the big hairy problem is we live in a day and age where information is abundant. But this also means that there's going to be information overload. And I really believe that it's not information that is scarce. It's the ability to focus that is scarce. It's the ability to focus and the willingness to learn that is scarce. The thing is, like, if you start trading stocks right now, you will notice that you are going to be drowning in noise. There's so many different economic news. There's so many different earnings reports. There's so many like financial reports, balance sheets that you have to study. There's so many gurus. There's so many random noise on Twitter, and it's just endless. And the thing is, most of this information doesn't really affect what you do on a day-to-day basis. It's not a factor that is within your control. And the thing is, if you cannot discern between signal and noise, you're going to end up getting drowned with all of this information and not knowing how to actually act on those information, how to actually execute. When in reality, it's the execution which actually makes you money. And also, like most people nowadays, they are used to instant gratification, right? They are used to getting things done their way whenever they want, right? So as a result, when they start trading stocks, they can't sit still. Right? And it's the inability to sit still and do nothing that causes them to lose money. They start taking trades out of boredom. They start over trading. They start changing the stocks in which they are trading. They start chasing the hot stocks, the penny stocks, just because the favorite trading influencer is talking about it. And then they start panic selling at the worst time possible, right? When they should be buying the dip, they are selling the dip. So in order for you to overcome this problem, I believe that the real edge is behavior, right? It's what you do on a day-to-day basis, how you show up every single day, because that's something that is within your control. And the stock market, it rewards boring consistency. It rewards you if you stick to a watch list and you trade the stocks in which you plan to trade. And it rewards you if you have done sufficient planning, research, and preparation, and you have like a very clear valuation framework to decide which companies are worth buying and which companies are too difficult for you to understand, right? Which companies are within your circle of competence. And you just continue to stick to your risk parameters for months, for years, for decades. So here's how to win in this game. There are two groups of people who tend to play this game. Number one, that's the long-term investors or the swing traders. And then number two is the short-term traders. For the long-term investors or for the swing traders, patience is your edge. If you look at the greatest investor, Warren Buffett, who is undisputedly the greatest player in this game, he has a 4% win rate. That means that out of the 400 stocks that he has purchased, only 12 of those stocks gave him the outsized returns, which allows him to make billions of dollars every single year. Now, he didn't make billions because he's right all the time. Like I said, he's right only maybe 12 out of 400 times. He made billions because he was patient enough to hold on to the winning stocks for an extended period of time. Right? So it's his patience that actually paid off. So it's safe to say that it's not just his business acumen or his ability to look for great companies, but it's also his ability to be patient that actually pays off in the long run. So the money isn't made by clicking the buy and sell. It's made by holding the winners, whether that's a winning position or that's a winning stock, holding the winners long enough for compounding to do its job, right? So if you guys know the compounding effect, you will know that it's exponential. The longer the runway, which means the longer you hold on to the winning stock or the winning position itself, the more room you give it, right? Which also means that the returns is just going to compound slowly and slowly, and you're just going to get like this snowball effect where your returns just 10x or 20x over time. But the thing is, you have to give it a long runway for it to go. So if you're either a long-term investor or a swing trader, you're much more better off finding great companies, right? Finding the stocks which present the most amount of trading opportunities, and then just buy them at a fair price, right? Buy them when they collapse significantly, and then just hold them for a longest time and just let time do the work. Now, for the short-term traders, which is my scalpers and my day traders, there is two tips that I want to give you. Number one is that you want to trade when it matters. You want to trade at the best time, when there's actually institutional flow of money, which means that institutions are actively trading the market, which means you can expect a huge move that is going to happen in the market itself. That's the best time to trade. And this is when most money hits the market, right? Which is usually during the New York Open. Okay, the New York session open, the opening of the New York Stock Exchange. This is where you can see price move up or down significantly, right? So your goal is to try to capture those moves before they actually happen. And outside of these active windows, you will realize that price is often just like chopping around, just wicking, right? As this is especially true for pre-market or post-market, which means that you're gonna get baited into mediocre setups and you're gonna bleed small losses. You're gonna get stuck in this consolidation and you're just gonna lose a lot of money, right? So if you're a short-term trader, your job is to make sure that you show up when the market is alive, not when you are bored. Professional traders do not trade all the time. They only trade when the market is capable of paying them. Think about that for a minute. And the second rule is that you only want to trade stocks when there is a clear reason to do so, which means when there is some form of catalyst. Now, stocks don't move hard and fast just because it's bought, right? Just because, oh, today is Tuesday, price is going to go up. Or today is Wednesday, price is going to go down. No, that's not how the market works, right? They move because there's a catalyst that is driving price. Which also means that if you're trading stocks, you will realize that the cleanest day trades usually happens when there's a clear driver. Whether earnings report comes out, right? The actual earnings beat the expected forecasted earnings. Or financial analysts upgrade or downgrade a stock, or where there's major news, where there is sector momentum, or where there's like a big macro event that actually affect the market as a whole, right? So that is where you will see That's a huge move that actually happens in the market. Which also means that if there is no catalyst on that day itself, right, there is no sentiment, there is no liquidity, you're basically just day trading randomness. And randomness is where discipline dies. There is no alpha, there is no edge in randomness. And you know what? I'm just gonna give you like one bonus rule, right? The third rule is do not chase headlines. There's this philosophy in stock trading world called buy the rumor, sell the news. Most people, they wait for the news and then they chase the move. And that's exactly how they become exit liquidity, right? So for example, if Tesla is going for like an earnings report, right? And then it turns out that the actual earnings beat the expected earnings. So when they see this good news comes out, they start entering for a buy. But then what happens next is that the market start dumping on them, right? Price start going down significantly, even though the actual earnings beat the forecasted earnings. Why is that so? Well, it's because of this philosophy called market manipulation. It's because of buy the rumor, sell the news. The rumor is the positioning phase. Price often runs before the headline. So in that Tesla example, you will see that if everybody is expecting Tesla earnings to beat the forecasted earnings, they're going to start buying, right? They're going to start buying before the news actually comes out. And that's what drives price up. And then when the news eventually released, the news is the expectation check, which means that it can be good, right? Like what I mentioned just now, and it can still dump if it wasn't better than what was already priced into the market. So quite simply put, you don't trade what the headline says. You trade what the market does right after it drops with tight risk parameters, right? Because remember, anything can happen. So you always want to make sure that you protect your downside. The next asset class is crypto. Now, crypto basically means that you are buying and selling digital assets that move in cycles and narrative. In plain English, this means that you are riding hype and fear swings, right? You're pretty much trading with the sentiment of the market. This is for people who can handle extreme volatility, trade market cycles, and still stay disciplined when it's euphoric or when it's crashing down, right? Because those are the two cycles of the crypto market. It's either going up like crazy, right? Which means the market is in the euphoric phase, or it's coming down like crazy, which means that the market is in a fearful phase. Everybody is thinking that crypto is going to go to shit, right? And then the third scenario is where price is just not going anywhere. And it's just institutions accumulating, just waiting for the next phase to happen, right? Which is the euphoric phase again. So the pros of crypto is that the market is open 24/7, right? It's open 24 hours, 7 days a week. Which means that you don't have to wait until like 9:30 for the market to actually open. No, opportunity is always there, right? Because the market is decentralized, which means that there is no third party that's actually controlling it. There's no government, whatever. And there's also big move when the trend is strong, right? Like I said earlier, when everybody is euphoric, right? When the trend is very strong, you start seeing Bitcoin go from 80K to 100K in a few days. This is where you will see big move. Right? Because when crypto trends, it really trends, right? It really just go up in a direction for a longest time and just go up far and fast. And that's where the money is, right? Which means that if you can just capture a small portion of the huge move, boom, you can make a lot of money, right? But it's timing the move that's difficult. And it's also easy to access, right? Literally anyone can start, anyone can go to Coinbase, right? To create an account and then just start trading and just buying, selling crypto coins with as little as, I don't know, $10, right? Once again, low barrier to entry, accounts are very easy to open, and you can start with small capital. Now, 24/7 access might be a pro, but if you look at it from a different lens, you'll realize that it's also a con. So it's a feature, but it's also a bug. It's a benefit, but it's also something that is not that good. Because 24/7 markets means what? Means that you can trade anytime you want. And this tends to lead to over trading, where the traders start trading on Monday, they make some money. Tuesday, they trade again. They give back the money they've made on Monday to the market itself. And then now they are in a drawdown. And then they continue trading on Wednesday. And then now they lose even more money because now they're emotional and they're making stupid decisions. And like, they do that every single week. And they wonder why they are not profitable. So it requires a lot of discipline to just stop, to know when enough is enough. Which also means that if you're undisciplined, right, and you're trying to trade every single move, every single hour, every single minute, every single second on the chart itself, then you are going to be cutting yourself, right? You are just going to be sabotaging yourself. There's also insane volatility, right? Because think of crypto, super unpredictable, super volatile, right? Which means that it can rip or it can also dump for weeks. And if you're over leveraged, which is a lot of crypto traders do, you're gonna be gone before you're right. Like once again, you over leverage, you enter for a buy, and you expect price to go up. But then it continue going down, and you continue buying the dip, right? And then just continue going down even further. With leverage, continue buying the dip with leverage. Next thing you know, you got margin caught, and then the next day price starts going up. And then you're like, oh my God, no, why, right? Well, it's because that's the nature of crypto, right? That's the game you choose to participate in, right? So you have to accept the rules of it. And one thing that I really don't like about crypto is there's so many freaking scammers right now, right? There's like shady exchanges, there's influencers, shilling meme coins, and the market is just full of traps, right? It's just an ugly place. This is why if you tell me that you're a crypto trader, I probably won't take you seriously, right? Like even though you could be like making a lot of money, I probably just won't take you seriously. You know what I mean? Like you're much more better off just telling me that you sell avocados or some shit. The big hairy problem with crypto is that it's incredibly unpredictable since it's very sentiment based, right? It's really heavily dependent on what the entire market does as a whole. For example, when Elon Musk tweet, oh, Dogecoin is going to go to the moon, boom, Dogecoin goes to the moon. Everybody believe in that narrative. Or when Donald Trump suddenly tweets, sell Bitcoin, everybody starts selling Bitcoin, right? So you can see, it's really based on the sentiment of the market itself. And the thing about sentiment is that narrative drives sentiment, right? Which is the story that we tell ourselves about crypto. And narrative, it changed much faster than fundamentals in crypto market. Which means price can move based on vibes, right? Based on what the market is feeling, whether they are bullish or bearish, rather than based on the underlying value of the crypto itself. And sometimes that sentiment can shift overnight. 1 minute, everybody could think that Bitcoin is the best asset class, is the most safest asset class. It's like the digital gold in crypto. The next minute, people could think that, oh, Bitcoin is go to shit, right? You can see the sentiment can shift overnight. And that's what makes crypto incredibly dangerous. And also, in the crypto market especially, euphoria and panic are amplified, which means that you'll see tops and bottoms. Those are the emotional extremes, and most people tend to trade inside those emotions. They tend to buy at the top, and then they tend to sell at the bottom, right? Because they're so goddamn emotional. So here's how to win in this game. The real framework is this, okay? Listen up. Price drives narrative. Narrative drives positioning. Positioning drives sentiment, and sentiment drives price. You realize that it's a loop. And once you see it, you can't unsee it. And once you actually see it, you understand how the crypto market works. You will understand that the price of crypto is not actually dependent by the fundamentals. It's dependent by the sentiment. And the sentiment is dependent by the positioning, and positioning is dependent on the narrative, which is the story behind crypto. It's the story behind a meme coin that makes it valuable, right? It's not the team, right? Maybe the team contribute to it, but mainly it's the story, right? Because the story gives the perceived value of the crypto asset itself. So here are the rules when it comes to crypto, right? You want to trade small enough to survive volatility. If your size forces you to panic, you're trading too big of a size. You're over leveraging, right? So size down. And you want to have defined exits before you actually enter. You must know exactly where to get out of if the market doesn't go as planned. And you must know exactly where to get out of if your trade idea does play out, right? So you need to place your stop loss, you need to place your take profit. Crypto rewards good exits more than perfect entries. Remember that. And last but not least, don't be the diamond hand sort of trader, all right? You can do that when it comes to investing, but when it comes to trading, you need to just accept the fact that you are wrong, right? You need to prioritize making money over ego. Prioritize making money over being right? So don't become a bag holder if you are trading crypto. You want to make sure that when the market proves to you that you are wrong, you get out of the trade ideal and you cut your losses fast. Remember, amateurs obsess over entries. Professionals obsess over exits, because exits are what keeps you alive in the game long enough so that you can actually capitalize on the opportunities that will give you the outsized returns. Next up, we got Forex, which is honestly the one that I have the most experience in. After all, this is what I spent the past 7 years mastering. So you can say that I got a lot of experience in this game, right? And I know exactly what I do. At least that's what I tell myself every single day. Anyways, when it comes to Forex, the definition is you're essentially trading one currency against another as the economies of the country and the interest rates of the country start shifting. So in plain English, that means you are betting which currency is stronger, right? So if you buy Euro USD, because Forex currencies tends to come in pairs, you are essentially buying Euro and you are selling USD, which means that you are betting the currency of the Europe is going to go up and the currency of the United States is going to go down. And this is for people who like structured routines, which is sessions, clean rules, and mechanical execution. And most importantly, can respect leverage. Okay, if you can do all of those stuff, you're going to have a very fun time in here, right? If you're able to do the boring, repetitive tasks for an extended period of time without expecting results, without getting immediate gratification, you're going to win in this arena. The pros for Forex is that the market is open 24 hours, but unlike crypto, it's only open 5 days a week, right? The working days, Monday to Friday. So this is really perfect, right? If you're trading a 9-to-5 job and you can't trade from, let's say, 9 a.m. to 5 p.m., then you can potentially trade from 6 p.m. till the time you go to sleep at 10 p.m., right? So it gives you a lot of flexibility. And Forex requires very little capital to start because of leverage, right? In Forex, we have this ridiculous leverage, right? You can essentially 500x your account if you want, right? That's the amount of leverage that Forex brokers give you, or rather some brokers give you, which means that you can participate in this game with a smaller account, right? $100 account, $50 account. My first account was $20, right? So you can really start with as little money as humanly possible. But that said, if you start with such a small account and you over leverage and you don't manage your risk, you're gonna blow up very fast as well. Right, so leverage is essentially like a double-edged sword. It can help you, but it can also hurt you if you use it incorrectly. Structured sessions, right? So in the Forex market, there's your Asian session, your London session, and the New York session. And depending on these sessions, the currency pairs that you are trading are gonna be moving a little bit differently, right? For example, the Great Britain pound, it tends to move a lot more in the London and the New York session compared to the Asian session, right? Same as the US dollar. This means that if you look at it from the grand scheme of things, you will realize that the market has a certain rhythm, right? Which means that you can trade the same window every single day and expect the same patterns to appear, right? Once again, it's not going to appear exactly like it did yesterday, but if you have built your pattern recognition skill, you will be able to know that, okay, this has happened before, right? So the next time this happens at this timing, I'm gonna execute, I'm gonna enter, and I'm gonna know exactly what's gonna happen next, right? And that's how Forex traders actually profit. Now, the downside, what's not so good about Forex is honestly as much as the upside. Number one, it's easy to over leverage, right? Like I said, small account, right? High leverage means that it's easier for you to make money fast, but it's also a lot easier for you to lose money fast. And to me, I really believe that most Forex traders lose not because of bad entries, not because they don't know how to analyze the charts, but they lose because they use a lot size that is way too big for their account. They use oversized position sizing, right? They're pretty much just over risking, over leveraging, not practicing proper risk management rules, and that's why they blow up. And also, there's going to be a lot of sideways markets in Forex especially, right? That's just the nature of a market that moves 24/5, right? This means that sometimes the market will present you good move, right? Where price is trending up or down. But a lot of the times, or rather 70% of the time, the market is just going sideways, right? And once again, I will also believe that sideways markets has killed more traders than bad strategies. Because when the market is going sideways, we tend to overtrade. We tend to doubt ourselves, and we tend to give back weeks of progress, right? We tend to give back the profits that we've made back to the market, since this is where we tend to make stupid decisions. And in Forex market, or even the other market in general, emotions are the number one killer, right? People tend to revenge trade after a losing streak because they want to get back at the market. They want to get back the money that they have lost. People tend to take trades out of fear of missing out, right? They think that, oh, this is a once-in-a-lifetime opportunity. Let me enter and try to get in on that. And then they have this mindset where, oh, I'm gonna win one more trade and I'm done for the day. And that's what caused them to overtrade, right? So you can see all of these emotional mistakes cause them to actually make bad trades. And those bad trades leads to unnecessary losses, which could be avoided if you have a structured framework, if you have a structured routine, right? So like I said, if you're disciplined, this is the best market for you, right? You're gonna make a lot of money from this market if you can be consistent and focus on the right things and just focus on the right setups. And one thing that I really hate about the Forex market, I really think that this is the one thing that brings like a bad name, a bad reputation to the entire Forex industry, is there's so many fake gurus out there, and there's also a lot of products, a lot of software that have a conflict of interest. Right, it's like, for example, brokers. Forex brokers tends to make money when you lose money. They have such thing called an A book and B book, which I'm probably gonna dive into it in another video. And then there's also your funding challenges, right? On the outside, it seems like they're trying to give you money to actually trade, right? But what happens is that they're actually profiting from you losing the refundable fee. They're actually profiting from you actually failing the funding challenges itself, which is why they make the rules quite difficult to actually pass, right? So you can see all of these companies in the Forex industry literally exist to make you lose money so that they can make money. Except for Edgeflow, which is the trading super app that I'm building right now to help traders become consistent and become profitable. Right? Okay, like that's just a generalization, but to me, you know, I've been in this game for like the past 7 years. I've really like looked at like the behind the scenes of how these companies run things. I've been behind the curtains, and I can tell you all of these wankers out here are just trying to get your money, okay? Because when you lose, they win, right? So you can see there's a clear conflict of interest. Like there's just too many people, too many gurus, and behind the scenes are just getting paid when you lose, right? That's why you see all of these gurus like promoting the brokers and funding challenges, because they are getting a certain commission, right? They are getting a revenue share when you actually like lose money on those brokers and the funding challenge itself, right? So you are literally sold hype instead of skill. Now, the big hairy problem in Forex is discipline under noise. There's just too many noise in the Forex industry. That's why I always say the edge isn't in spotting A+ setups. It's in ignoring everything else. The hardest part about trading isn't spotting opportunities. It's in deciding which opportunities are worth capitalizing on, which trade setups are worth taking and which are not, when to trade and when not to trade. It's like, just because you can doesn't mean you should. You can trade everything. So you will, unless you have rules, right? It's like if you don't have rules, you're gonna end up trading all these different currency pairs. You're gonna use all these different time frames, use all of these different strategies and concepts, and you're not gonna get anywhere. This also means that the best form of risk management is saying no. Saying no to the low probability setups, saying no to the hype, saying no to the times that you shouldn't be trading, saying no to, trading when you are emotional, when you are physically and mentally exhausted. For me, I really believe that the name of the game in Forex trading or in trading in general is consistency. Which means that the more consistent you can be, the longer you can be consistent, the higher the chance of you succeeding in this market. Because most traders, they don't fail because their strategy sucks, or they don't know how to analyze charts or identify chart patterns or candlestick patterns. They fail because they can't execute the same strategy every single day. They start getting distracted by the next shiny thing instead of focusing on the thing that will actually make them profitable. That's why they fail. So here's how to win in Forex trading. You must understand how the market works. And you must understand why price move. And in order for you to do that, there is two things that you want to master: liquidity and timing. I believe that the highest leverage skill in trading isn't memorizing chart patterns or laying on different indicators. It's really just understanding liquidity and timing. Because liquidity tells you where the market will move. Timing tells you when it's about to explode. Liquidity is the fuel. Timing is the ignition, which means you need both in order for price to move significantly, in order for you to ride the institutional flow of money, right? So if you can master both, this is where you can enter the right trades at the right time, at the right place, before the real move actually happens. And that's the greatest superpower ever. And you also want to make sure that, like I said earlier, you have a structured routine and you have mechanical rules. So for me, I believe in the importance of building a repeatable execution engine, which is what I call the 5R framework. Record your trades daily, review them weekly, reflect on them monthly, refine your trade plan quarterly, reassess your trading goals annually, and rinse and repeat. This is how you turn trading from vibes, randomness, into compounding skill, into structure and order. Because remember, consistent actions doesn't necessarily guarantee consistent results, but inconsistent actions guarantee inconsistent results. So if you want to get profits consistently from the market, you have to be consistent with your actions. And that's how you do it. Next up, we got futures. When you trade futures, you are essentially trading standardized contracts on the price of an index, commodity, or rate, usually with margin, leverage. So in plain English, once again, what you are doing is that you're trading these big markets with built-in leverage. And this is for people who want to trade indices, commodities seriously, right? And you like fast execution, you can keep your size small and controlled. This is perfect for you. Now, there's a few upsides when it comes to futures and making it like one of my favorite asset classes to trade. Number one, this is perhaps like the most important upside, is that it provides incredibly smooth price action. The majors like the Nasdaq, the S&P, they tend to move very clean, right? Which is why if you're a trend trader, you are trading the trend, you're buying when price is going up or selling when price is going down, you're gonna love futures, right? Because when price trend, it tends to sustain that trend for a longest time. Next, you got lower execution costs, right? Which means lower commission costs, lower fees, right? Which means that you get to keep more of the profits to yourself, making futures a lot cheaper to trade compared to the other instruments. And then last but not least, if you're based in the US, right, you can actually get some tax benefits, right? It's a lot more favorable to trade futures compared to the other asset classes, especially if you're in US. Cons. News volatility can humble you, right? Sometimes when news comes out or events comes out, there's going to be violent swings in price, right? So even though once again your trade idea could be right, you do a technical analysis, you mark up your charts, you realize that you want to enter for a buy here and here, right? But then guess what? News comes out and it causes the entire market to change direction, right? So even though you're right technically, but you are wrong fundamentally, you're going to get humbled by the market itself. And it's also more nuanced than stocks, right? There's a lot of small micro variables that you need to take into account of, right? Like the expiry dates, the contract specifications, the rollover, right? The tick value. All of these are like extra layers that beginners tend to underestimate, but that is so important when it comes to trading futures. The big hairy problem when it comes to trading futures is position sizing and volatility control. Right, so to me, futures is just like indices, commodities, or stocks on steroids. Right, it's like whatever stocks, all of these are, right? You add them and you give it a little bit more fuel, right? You make it a little bit more volatile. Like volatility isn't constant on a day-to-day basis. The same stop loss distance, it can work well on a day where it's quiet, but it can work not so well when there's a lot of volume, a lot of volatility on that particular day itself. And if you don't have rules, you're gonna tend to react emotionally and just spiral out of control. And also, since you trade futures, you are trading ticks, okay? You are trading contracts rather than each individual stock itself, which means that if you size your position, you size your trade wrongly, it can turn like a small loss into like a big loss. So here's how to win. You want to specialize in 1 to 2 contracts max, right? Whether that's, for me personally, NQ or the SPY, right? So just find the one that works for you, right? Gold contracts or oil contracts or whatever it is, and just spend the next few years trying to master those future contracts itself. Basically, I view it like getting to know a person. You have to learn their behavior just like you are studying a person, right? For example, if you go on a first date with a girl, you might get to know her on a surface level, right? Like what she like to eat and what's her hobby, what she does on a day-to-day basis. But you don't know her on a deep emotionally and spiritual level until you have spent multiple dates with her, right? Until you have spent like a few months with her. It's the same thing right here, right? It's like getting to know a new asset class, getting to know an instrument is just like dating, which means the more exposure you get to that particular instrument, that particular market, the better you get at understanding it, which also means the better you become at trading it, right? So yeah, just find out what's the 1 or 2 contracts that you want to master and just spend as much time as humanly possible getting to know it. And also you want to keep your position size small and boring. Okay, once again, your edge isn't in being brave. Stop trying to be a hero. Start trying to be consistent. Your edge is being able to survive 100 trades without blowing up. Okay, it's survival. It's not making money. Making money is lateral. The formal, first and foremost, focus on survival. If you can survive, then you can live long enough to make money in this market. And in order for you to survive, you need to make sure that you can actually take multiple losses in a row. And that's why it's so important for you to keep your position size small and boring. And next is you only want to take high probability scenarios. If your setup isn't clean, do not force it. If you can't explain your trade ideal into the mirror without cringing, it's probably not the right trade ideal, right? So you want to make sure that you have multiple confluences. You look for the trade ideal only after you have done your mapping process, after you have marked up the charts and you figure out your bias and the objective of price. And you only want to enter once every single one of your entry criteria has been met. And ideally, that needs to be at some form of high probability point of interest, a good location, right? So remember, you want to get as much confluences as possible and you only want to be trading high probability scenarios because futures punish. Because if you start forcing trades, futures is going to punish your ass. All right, that's it. Next, options, right? There's a reason why I'm covering options the last. It's because this, in my opinion, in my humble opinion, is the most difficult market to trade in. Basically, options trading means that you are buying or selling contracts that give you the rights or the obligation to buy or sell later at a price before expiry. Okay, sounds like a lot, right? In plain English, it basically means you are buying a time-limited bet with rules, which means that you are buying a ticking bomb, a bomb that will explode at any given time if you don't understand the mechanics of it, if you don't understand how to defuse the bomb properly. So this is for people who already understand the underlying market and want to structure risk, right? Either hedge against it or define the downside. It's definitely not for gamblers looking for lottery tickets. I know a lot of you guys watching this, you guys probably got into options because you see all of these traders out on social media making a ridiculous amount of money trading options, right? Like for example, when you buy Apple stock, you make $100. But when they buy Apple options, they make $100,000. That's the pro of options, but that's also a downside if you don't understand how to trade it properly. You're just going to compound your losses, right? So the pros is that you can make money very fast if you do it right. The thing about options is that it amplifies move when you are correct and early enough, right? So it's like on a stock, it can move like this. But the same move on the stock option, just because it's a different asset class, a different market, you can make like 10 times the profit. Same move, 10 times the profit, right? So you can make a lot of money fast if you are correct about the direction and you are early enough to capitalize on the move. And they also provide you with asymmetric risk to reward, right? Which means you can have limited downside and you have unlimited upside if you know once again how to structure your options properly. And it's great for hedging, which means you can protect a portfolio or position without selling the underlying. And there's also certain strategies which allows you to benefit when a stock actually drops, right? So for example, if you want to buy the dip, you can actually benefit from the stock dropping to the dip itself, and you can also benefit from like buying at your desired price, and the market will actually pay you for it, or rather the option market will actually pay you for it, right? So there's a lot of these like cool strategies that we can deploy to actually benefit from any sort of market condition, whether that's a trending market where price is going up or down, or even when price is going sideways. Once again, if you understand how to use options properly. Now, the con is that there is just way too many variables for beginners. There's just too many things to understand about options to trade it properly, right? It's like you cannot just be right about the trend direction. You also need to know how to fight time, which means you need to know when price is going to play out, the way you envision it to play out. And you also need to fight volatility, which is super unpredictable, super hard to predict. And you also need to fight pricing mechanics, right? Which is the Greek, right? Like the theta, all of these other Greek, all of these other variables. Once again, I'm not going to go through the in-depth details in this particular video itself, but basically there's a lot of things that you must take into consideration before you enter for a put or a call option. Now, the big hairy problem is direction is easy, but timing and survival is hard. It's like anybody who understands technical analysis can know that price is going to go up or price is going to go down. But what's difficult about trading is knowing exactly when that move is going to happen and having the risk management to stay into the game long enough so that they can actually benefit from the move itself, right? So it's direction plus timing equals success. Especially in option trading, you are trading time as much as you are trading price. Being right, but if you're late, you still lose, right? Because the expiry doesn't care. The contract will just expire. And also, like I said, there's other variables like the volatility pricing, right? That's like the hidden boss, which means once again, you can be right about the trade ideal, but still lose if your IV crushes or the premium is overpriced. Okay, so once again, there's just so many different like nuances when it comes to this. And a lot of people, they just treat options like lottery tickets, like, okay, I'm just going to enter for a buy for Apple share and I'm just going to expect price is going to go up. Okay, and that's it. No, that's not how options work, because like I said, if you do that, what happens is that you might not be able to survive the wait and you start panic selling. You start revenge trading or you start rolling into worse positions. All because you don't understand the mechanics of this game itself, the rules that govern this entire game. So here's how to win options trading. First and foremost, please earn the right to trade option. I don't think option is for everybody. In fact, I think it's only for people who have really understood how to trade stocks or crypto or forex or futures, whatever. They understood how to trade the underlying market. That is where they can come onto options, right? So you want to earn the right to trade options. You don't want to size up until you have understood the basics of option, the rules of the game itself, like the payoff, the expiry, the intrinsic versus extrinsic, and why the premium tend to change, and the expiry, all of these other stuff right here. And you also want to use options to define risk, not chase dopamine, not chase fast returns, not chase outsized returns, but to define risk. The best use case for options is protection, is structured exposure and controlled downside, right? Not like, buying put or call options and just like YOLO it. No, that's just not how it works. And you also want to match the contract to the trade idea, which means that if you don't know the time frame in which you're trading and you don't know what invalidates the trade idea, you're just gambling. Like, you need to be able to think 5 moves ahead. Good traders know what could potentially go wrong. Great traders think about the consequences of their actions, right? They know that, okay, if I buy a put right here, or I sell a call here, or whatever, right, this is going to happen. Okay, but there's also all of these different scenarios that I need to take into account of, right? What if the IV does this? What if the contract actually expires at this date? So on and so forth. It's like great option traders, they take into account every single one of these variables right here before they enter for the trade ideal. Like, they spend much more time in the preparation phase, in the research phase, in the analysis phase, than entering into the option trade itself. And I really believe that options is gonna punish vibes more than like any other game out there, right? It's gonna punish discretion and just guesswork more than any other game out there. So if you're trading based on your gut feeling or based on, your emotion, this is the market that you want to steer clear away from, right? Because you're just gonna get effed. Now, the question becomes, Cool, Brad. I've understood all of these different asset classes. I've understood what's good about it, what's bad about it, how to master it, and what's the one bottleneck that I need to remove about it. The question becomes, what market should I trade? What market should you trade? And here's the truth. No matter what market you choose to trade, it's going to be difficult. Okay, I hate to break it to you, but it's going to be difficult. There's no perfect market. Remember, the grass is never greener on the other side. Like every market looks sexy from the outside until you actually try to extract money from it. Until you actually try to trade it for like 6 months. That's when you realize that, wow, the market is actually a catfish. Right? Crypto looks easy, but it's not. It's super duper gamblish, right? Like gamble-ish. Every single market has its own features and bugs. Has its own good stuff and also its own bad stuff. And if you want to get the good stuff, then you must be willing to endure the bad stuff. Right? Like the bad stuff is the price that is required in order for you to attain the good stuff, right? The money, the freedom, whatever. Stocks punish impatience. Crypto punishes greed. Forex punishes indiscipline. Futures punish bad sizing. Options punish bad timing. Right? It's like all of these are mistakes that you will commit no matter what market you choose to trade in. So stop asking yourself which market is the best, but rather ask yourself, which pain are you willing to endure long enough to master it? And I highly recommend you to choose the one that you love to trade the most. Because the heart wants what it wants. Right? It's like right now, at this stage, you should already know which is the asset class that resonates with you the most. Which is the one that you are willing to spend the rest of the time to master. That's the one that you should be picking. Because like I said, every market has a price of admission, right? There is no such thing as a free money market where if you go into crypto, you're going to make more money than the other guy who go into Forex. No, there's no such thing. There is only 4 steps. Pick your game, learn the rules of that game, pay the tuition in the form of losses, and earn consistency. That's it, right? It's like every single market works. Every single strategy is profitable. Every single trading style is good. But you're not going to get anywhere unless you pick your game, unless you choose the one that you want to master and just invest your time, energy, attention, resources into that one thing. So I want you to treat trading like pursuing a degree in university. Forget about profitability or making money for the next 3 years and just focus on mastering the skill set, the ability to analyze the charts with confidence, the ability to control your emotions, the ability to get back to a mental equilibrium after a losing or winning streak, and then just pay the tuition fees in the form of losses, right? Like as harsh as that might sound, but you have to pay the tuition fee. That's the only way you can learn, right? The best way to learn is to do and fail and learn from your mistakes. And then eventually you will get paid consistently from the market, right? It's like that's the holy grail right there. And if you're not willing to pay the price in the form of losses, you will not be able to gain the experience that is needed for you to actually thrive in this market, for you to actually get the money and freedom and lifestyle that you are craving right now. Most traders, they don't lose because the market is too hard. They understand this process that I just laid out, but they lose because they keep getting distracted by the women in the red dress. They keep switching games every time it gets uncomfortable, every time it gets hard. When in reality, you have to understand that every single game that you choose to play in, there is going to be the hard things, right? It's a constant. You can't get rid of losses, right? That's just the price that you have to pay in order to get freedom. And the losses is what makes the game great, right? If you win all the time, this game will be boring, right? You won't be interested in playing the game, right? So you can see that simple mindset shift allows you to like just get laser focused on the one market that you want to master right now. Like I said, mastery requires depth, not breadth. If you keep changing the markets, you are essentially just resetting your pattern recognition to 0 every single time, which also means that you will never build real intuition. You will never build experience in the market. You will never stay long enough to see the full cycle, right? Because trading is not linear, it's exponential, right? So the outsized returns come in the 3rd year, the 4th year, the 5th year. But if you keep switching every year or every month, right, like how often you change your underwear, then what happens is that you're not going to last long enough to see the exponential returns. So to me, learning is not just studying and synthesizing information. It's application of knowledge and changing behavior. So here's what I want you to do. I want you to take action, which means I want you to complete these 4 steps. Pick one main market for the next 6 to 12 months. Whether that's crypto, futures, forex, or options, or whatever, just pick one. Okay, just pick one for the next 6 to 12 months. And once you are done doing that, you want to pick one primary trading style, whether that's scalping, swing trading, or day trading. And then you want to pick one window you will show up every single day, right? If you're trading stocks, the New York Open. If you're trading forex, maybe the London Open or the New York Q Zone. Just pick one time window which the assets that you plan to trade provide you with a sufficient amount of opportunities, and also a time window where like you are free to trade in. And then just focus on execution, right? Just focus on executing like a machine. That's the 4th step right there. And you can see it all comes down to the power of one, okay? One thing at a time. And if you're not sure where to start, I've created a free course on each one of these markets. Check out the multi-asset mastery playlist right below this video itself, right? And you want to, once again, find the one that matches your personality and just commit to it, right? There's a complete guide to options, complete guide to futures, complete guide to stocks. Everything is in the playlist itself, right? So go and check that out. And listen, whatever game you choose to play in, the next time you hit a roadblock, you hit a wall, do not panic switch. Do not switch to the next game. Sit with the resistance, overcome the resistance, and tell yourself this one thing. I chose this game. I chose these rules. So I don't get to complain when the rules show up. I don't get to complain about the bugs. When my goal is to create the features that will actually transform people trade forever, right? That's what I tell myself when I actually build Edgeflow, right? Like I don't get to complain about how difficult building a software business is, because that's the game that I choose to play, right? That's the price that I have to pay in order for me to achieve the results that I want to achieve, in order for me to accomplish the goals that I want to accomplish. And the pain that you are feeling in that moment, most likely it isn't a sign that you have picked the wrong market. It's usually just the price of admission for that market. For example, stocks feel too slow for you. Well, that's the fee you pay for compounding, right? For you to get the outsized returns in the long run. Forex feels too noisy and tempting for you. Well, that's the price you pay to get leverage and opportunity every single day. Crypto feels too chaotic. Well, that's the price that you pay for outsized move, right? For those 100x returns. Futures feels very intense. Well, that's the fee you pay for precision and clean execution. Options feel confusing, overwhelming, and unforgiving. Well, that's the fee you pay for asymmetric risk to reward, for the limited downside and unlimited upside. So instead of lamenting and thinking about switching to a different game, you either level up your skill to match the game or accept that you're not willing to pay the price. And if you're not willing to pay the price, then stop lamenting about the results you haven't earned. And whenever you feel like quitting, remember why you started in the first place. Not the hype reason, not because your trading friend asked you to actually join this market, not because your trading guru asked you to trade this market, but the real reason on why you started trading this market in the first place. Because the goal isn't to find a market with no suffering. It's to pick one suffering you can handle and stay long enough to turn it into mastery. Now, you might be wondering, which one do I trade? Let me just tell you like my personal trading journey. I started getting into the financial markets by getting into stocks, right? So I was learning how to invest in stocks. And then that later allowed me to discover forex trading, right? And that is where I fell in love with the financial markets. I really enjoyed day trading. I love the adrenaline. I love the kick that I get when I actually win a profitable trade, you know? And then that led me into crypto, right? When crypto actually got hype and all that stuff. And then for the past 2 years, I got into futures and also options as well, right? So you can see it's like this gradual process. It's not random. It's not like, oh, stocks didn't work out, so I'm just going to go to forex. Or forex didn't work out, I'm just going to go to crypto. No, it was like sort of like a linear process. It was very sequential, right? So I went from stocks, forex, crypto, futures, then options. I was simply following the levers of the game itself, right? Because that's just what these asset classes are. They are simply levers to the game, right? Options is the most difficult to trade. In my opinion, stocks is the most easiest to trade, and you can see like is this gradual process right here. And honestly, each market taught me a different skill that I needed for the next level. Stocks taught me about patience, how to sit through the noise, which I later on used in the Forex trading. And then Forex taught me about structure and execution, how to trade at the right time, how to develop your trade idea, how to have routines, how to have mechanical rules, how to trade like a professional instead of a gambler, which I later used that skill set to trade crypto. And then crypto taught me about sentiment, right? How narrative move price, how sentiment is really like all based on the narrative itself, how euphoria and panic create traps. And then later on when I trade futures, that taught me about sizing and precision, because we all know that futures doesn't care about your ego, and one mistake with size and you're done, right? So it's like very heavily emphasis on risk management, which then I use that skill to trade options, which then taught me about timing and risk structure. Not just, predicting the direction of price, but when that move is gonna play out and how to survive the wait. And then you can see different pillars, different markets taught me different skills, in which now I became like this multi-dimensional trader, right? I don't have a label on myself. I don't say that, oh, I'm just a Forex trader or I'm just a stocks investor. No, I don't like to impose label on myself, because I believe that you act in accordance to your own belief and the label that you impose on yourself. So I much rather be a poly trader, right? Which means someone who trade in all of these different asset classes and someone who continue to learn from the market itself. And after trading all of these different asset classes, I learned that the next thing isn't the edge. The next asset class is not going to magically make you profitable. The edge is mastery in one. And that's why nowadays I have one main game in which I focus on for short-term trading, and I have one main game in which I focus on for long-term investing. In the short term, I focus on Forex trading. In the long term, I focus on investing in stocks, right? It's like those are like my primary focus right now. Futures, options, crypto, those are nice to trade maybe here and there when Forex doesn't present much opportunities, but majority of my times, I'm focusing on Forex. Forex because it fits my routine, my execution style, and it's where I'm the most consistent and the most experienced in. Stocks because that's where like the compounding is the cleanest, right? Like you can buy great companies at a fair price and hold them for the rest of your life if you already have positive conviction in them. And also, like I said earlier, I'm building an investment portfolio that lasts, right? I'm building like an 8-figure portfolio. And the best way to do so is by buying stocks. So I guess like my point here is the main takeaway isn't trade what I trade. The takeaway is choose your game based on who you are, based on your personality, your trading style, your values, your goals, and then just go all in long enough to actually get good at the game that you choose. That's it, right? There's no perfect market. There's no one size fits all. There's no holy grail market. There's only the market that you're willing to master, right? Whatever market you choose is going to be painful anyways. You're going to suffer losses anyways, right? So choose a pain worth suffering for. Pick one game, learn the rules of that game, and pay the price of admission long enough to get consistent. That's how you win in the long run. Alright, so if you want help choosing your game, check out this multi-asset mastery playlist right here, where I once again gave you a free course for each one of these markets I just covered in here. And remember, whatever game you decide to choose, just remember that you're just one trade away. Mwah.